All right, I believe we are being live streamed. This is the Investing Power Hour number 56. My name is Brett Schafer, and I'm joined, as always, by Ryan Henderson. On these episodes, we talk about whatever we want in the financial markets, investing, business news, whatever. It might spear off into a succession discussion right now for a few minutes if we ever get to that. But we got a lot of topics this week. We have new news on the banking panic, which Ryan will cover. There is lots of earnings. I'm not sure which ones we're going to talk about in detail, but we are going to talk about some. There are a lot of fun companies to cover this week. I have the Microsoft Activision Blizzard news, and then some interesting charts about housing and excess savings in the economy, if we can get to them. Ryan, how are you doing? How are things earnings season wise? Disappointing to see the Activision Blizzard news, but maybe we'll hit that later.
Yeah, it was disappointing. It sounds like it maybe still isn't over. The controversy continues, but it certainly prolongs the acquisition period, which if you're in the merger arb space, or if you're buying anything because you think the acquisition will occur, the longer that it takes, the worse off you are in terms of rate of return. So little disappointing, but
we'll talk about that later. We'll talk about that later.
Earnings season has been fun though. It's been all right. I feel like there's always way more anticipation than what the results bring. Like everyone's like, this is a make or break quarter. Seems like they say that every quarter.
Yeah.
And then the results are always just a mixed bag and kind of a continuation of the same stuff that's been happening before.
Yep, and it's interesting to see what narratives get built from the current earnings period. It seems like there's always a few narratives that get attached, and then people run with it for a few months until the next earnings season, and then we see if it's actually surviving trend or just the narrative that's driving price in the short run.
We got Rod Alsman in the chat.
What is he
former
saying?
Guest.
Just go listen to his episode on, I forget the exact company name because it's so niche, but it is the engine company for trucks, semi trucks, or not even engine. It's
transmission.
Transmission. Yeah. Yep. Exactly. I
think it's called Allison Transmission Holdings.
Yeah. Been around for 100 years. Very fascinating.
If Rod's listening, he's going to be rolling his eyes, but yeah, I think it is. And it's, like kind of most people probably are unfamiliar with it. So go ahead, check it out. It's pretty interesting.
Yep. All right. Well, before we get to this episode, we need to talk about our sponsor, and that is stratosphere.io. It is our investing home screen for fundamental research. It has key KPIs for their premium plans. They are launching stuff that they're integrating Chat GPT, although they just did that, which I would just go check it out so you can get on their wait list there.
Let me share my screen.
Ownership. Oh, yeah. You want to share something? I had something to share, but let me
and I was listening to ourselves this week.
All right. Yeah, on the podcast.
I gotta say, it partly irritates me when we share stuff for the people that just listen. So we got to make sure we like very clearly describe it.
All right. Well, go ahead and share it, and test me, and I'll describe it. Okay. Well, oh wow, you used First Republic as well. I had that loaded up. It is a chart of First Republic. Well, we have the share price, which looks like not great. But now Ryan's going through their owner or their liabilities and asset table on Stratosphere, which is nice and clean and very easy to integrate with. He's looking at total liabilities, total debt, net debt, all the stuff that they aggregate for you and make it super easy to start really, the research on a company. You don't have to go through the SEC filings. You can read stuff that's actually readable instead of the filings that people put through. And let's see what he got here. Total average deposits. Well, things look pretty good for First Republic. Compounded growth rate of total average deposits of 21% since it was through the end of 2022. But then in Q1, everything just fell off a cliff. So, not one KPI makes or breaks a company. But yeah, they have these interesting KPIs for companies like like First Republic on Stratosphere that you won't find anywhere else, at least not for the price of either free or the smaller price that they offer. which is great for individuals or professional investors. So go ahead, check them out. Stratosphere.io, use our code CCM, get 15% off, and tell them we sent you. Link is in the show notes. Okay, Ryan, let's get to the topics for today. Any comments first or no? Just Rod saying hi.
Sorry, I was on mute there. Yeah, we do have another comment. Ben Cohn resigns. I had no idea who that was. That is the CEO of Playboy Enterprises. One of the people in the chat, Matthias, says he'll do his part. He'll step in.
Yeah, they're gonna have tough time filling that position.
Yeah. Anyway, yeah. So I don't know. It's been a super busy week, so probably tons to get to. Should we start with the most interesting? Maybe the banking panic continues.
Yeah, I think, go ahead. You had some notes on there. You did jinx it a little bit last week, although
Totally.
I don't know if this still might not be a full blown panic, but at least First Republic seems like it's still pretty much dead. But why don't you go through the details?
Yeah, I probably should have thought out the fact that right after I said the banking panic was over, earnings came out in a week, and it was, there were companies where we certainly didn't know how bad the problem was, or we didn't know what had happened to deposits because it hadn't been publicly disclosed. And then this quarter we saw, and well, First Republic was one of those. So First Republic, I guess I'm not that familiar with the business, or I wasn't prior to kind of what's been going on. A lot of investors that I respect were invested there. They said the customer service was incredible. Kind of would always go one step beyond to make their customers kind of feel welcome. However, it seems like they fell into pretty much a similar trap to Silicon Valley Bank, where they had a number of held to maturity assets. And those assets you don't want to have to mark down because then you get in trouble and earnings look horrible. And then so any sort of deposit outflows, you start to have this risk. And after the Silicon Valley banking crisis, a lot of investors and I think depositors were concerned that the same thing could happen to First Republic. And that fear tends to lead to withdrawals. And that's exactly what happened. So I guess just for context, I don't have the number right in front of me, but deposits, they said that deposits were only down, I think it was like 30 or 40%, but that included a $30 billion basically. I know, I mean, that's not great either. It included a $30 billion rescue fund essentially from the big banks in that deposit accounts. Well, I mean, I guess those are technically deposits, but it's it's a rescue fund. So if you exclude that, deposits were down, I want to say 60% in a single quarter, roughly. So obviously that kind of leads to more concerns for anybody that's left, that's a depositor that's looking at these results. And basically, I mean, there was a lot of writing about it. It's still kind of in limbo right now as to what exactly is going to happen, but
can we just end it? Let's just put them in, give them to someone for $0.
Well, I think it's better to have, so here's what's happening.
Okay.
And there's reporting from CNBC on this, and they said advisors to First Republic will attempt to cajole, I'm not, that's kind of my first use of that term. Cajole the big US banks who've already propped it up into doing one more favor. The pitch will go something like this: purchase bonds from First Republic at above market rates for a total loss of a few $1 billion, or face roughly $30 billion in FDIC fees when First Republic fails. Essentially, so I've got another quote here from Matt Levine that kind of highlights what would happen if they just let the bank fail. So he says, roughly speaking, if some banks fail, the FDIC is a mutual aid program and the other banks join in to bear the loss. But if there's a full-blown systemic banking crisis and lots of banks fail, the FDIC is a government guarantee and taxpayers save the banks. Essentially, it would also have, I'll read another quote. The specific mechanics of the FDIC insurance fund create another argument. If you let Bank X fail, that will cost the FDIC money, and the FDIC will just send you a bill for that money. So you might as well bail out Bank X yourself first. Essentially, they're going to be left carrying the bag anyways. So if they're able to kind of prop it up by buying these bonds, it might not solve the entire problem. There might still be kind of withdrawals and deposit outflows, but they said if they can get the $30 billion from these other banks, essentially taking a loss, it's going to lead some of the other kind of third parties that were interested in helping give some money said they would also pitch in. So basically they're waiting for the big banks to step in, and then they'll add some capital, these third parties, once they have a better sense that First Republic's not going to go down. The thing is, it seems like every time there's a banking crisis, they give like a half response that isn't enough, and then they have to give a full response. Where if you just do if you give them more capital to begin with, it probably stops it in its tracks. So it seems like, I don't know.
Could be hindsight 2020 there.
Yeah.
Because if you give them enough, then it doesn't become a crisis and you forget about it, but you remember the ones that become an issue and you have to double down on.
Yeah,
I get your point.
People would have referenced 08.
Yeah. But there's other situations, right, where.
Yeah, that's true. It sounds like, I mean, if I'm a depositor at First Republic and I knew about this, frankly, and I know I'd be contributing to the problem, I'd probably take my money out. But it sounds like they're going to get funded by these other banks in one way or another. Either the FDIC is going to foot the bill and then give it back to make the other big banks pay fees, or they're just going to get sort of a buyout package or a rescue package from the other banks. So I guess the banking panic isn't over. It still continues. And I should have thought about this earlier, but it's not necessarily, I don't think this is going to have a trickle on effect. I don't think other banks are going to see this. I don't think other depositors.
Banks. Yeah.
I don't think other depositors will pull their money out of their bank just because of First Republic or whatever. But what I do think is possible is that these banks that have long dated held to maturity assets continue to report concerning earnings numbers. And that might lead to anyone who's following the bank's earnings to say, oh, okay, I've got some uninsured deposits. Why don't I take some kind of risk off here?
Maybe. It seems much, much, much smaller than 08, at least right now, right? Like this is not even comparable to the size of the 08 crisis. So I just don't see it. And to be honest, when deposits leave, it helps unless people are putting money under the mattress or in Bitcoin or gold or wherever, it's going into other banks. So I think on a whole, it's almost just circular and everything's fine. The banks might not earn as much as they would if they're getting caught with their net interest margins compressing, but
you know what is
interesting to follow. I mean, some of these banks might be in big trouble if people start panicking even more, but it's in the real world, the story seems to have ended outside of the investing people who follow the investing news, financial news, business news.
Yeah. And the big banks I think the big banks are in an interesting spot because they probably aren't going to have to raise their, whatever their savings account yield, because no one really, no one gives a shit, frankly. Like if you have your money in a Chase account, are you really putting it there for the savings rate? Like, are you doing it because you want to earn money on it, or would you just move your money out of there? So I think they can continue to hold a really low savings yield and earn more on their assets and basically widen their net interest margin, while a lot of these other banks like Ally or any of the high yield savings account might attract more deposits, but they might have that net interest margin compression at least over the next year or two.
Here's what Rod commented. He said, an issue is the flow into money market funds and out of the banking system. Yeah, I'm going to kind of push back on you on the keeping money in the checkings accounts with low interest rates, is that it's very easy. And yeah, it's not going to be like, boom, overnight, half the people are going to say, I'm going to put something in a, what do they call them? CDs or a money market fund, something that yields 4% or higher or whatever the rate is right now. And I think that is just going to steadily happen. It might not, it's just going to be a trickle, but the higher rates stay this long, they're going to eventually have to raise rates. But compared to someone like, their loan book will eventually follow suit, right? They're not going to have to do it immediately. So I think, everything will be fine. We're seeing it. A bank we cover, don't own right now, but follow it pretty closely. Have it on the watch list is Ally Financial. They're kind of in the middle ground where they don't have any FDIC or uninsured deposit issues,
Like
but
10%.
yeah,
10%
very,
of the
very low.
deposits.
Yeah, very low. So there's not a concern that they're going to go through a panic, and they're growing their deposit base, but they're seeing major net interest margin compression as some people they have to pay out more on their deposits, and they've had to raise their interest rates quicker, or they've chose to do that just because they don't have the advantages of the big banks. And their people are moving into CDs and money market funds, but eventually their loan book is it has higher interest rates as well. So that the net interest margin they're earning is going to even out over time.
Yeah, it's an interesting point, and I probably should have mentioned it, but the big banks will earn more on their deposits, but it's probably quite likely that deposits will decrease on a per customer basis.
Deposits? What do you mean deposit? Like literal deposits, or you mean
So like if I'm a customer, so they don't have to raise their savings rate because people probably aren't really going there for that. And we've seen a net interest margin expanded for Bank of America and I think at JP Morgan as well, where they don't have to increase their savings rate, which might push some kind of, let's call it 10% of a customer's money to money market funds, but they're always going to have a certain percentage in their savings accounts or in their checking accounts. And Bank of America, JP Morgan, all the big banks are going to be earning more on that because they're going to be getting a better yield on their loans. So I guess it's kind of a push and take, but we've seen, I think, net interest revenue at Bank of America was up like 30% or something like that. I think it's the ones where maybe you don't use them as your primary bank, where there may be more deposit outflows. And I don't know what Schwab's case is, if that's like the primary bank for a lot of people, but Schwab saw 30% of deposits decrease year over year. So,
and move into, they're not necessarily leaving Schwab, but moving into a different asset.
More of somewhere where they can earn more money.
Yeah, that is interesting. Where some of the not all banks are created equal. We did have, I mentioned that this is way out of the, it's not in the mainstream news anymore, which is a good thing because you don't, a banking crisis can kind of cause itself if everyone thinks there's a banking crisis. But he said this is Matthias. This is a little bit of you're making fun of your friends here, but the plebes in my life, which is meaning I think non-finance folks, have moved on from sending me doom articles about the banking crisis, and they now send articles about the imminent collapse of the U.S. dollar reserve status. That
peso
is true.
On the rise.
the Mexican peso. We're gonna have I want them to make a global peso, or excuse me, a peso that's all of South America. It's just too confusing, and it would be so much easier. But I don't know anything about that issue. But I threw out there was something I was listening to about that, and again, total idiots about foreign currencies and reserves and stuff like that. But there was something that made me think of this idea where, let's say, Ryan, you have two choices. One, and I tweet out this poll if anyone wants to vote on it. First one is you can buy a South African 10-year treasury in South African, whatever, dollars, whatever they call it, yielding 10%. But it's 10 years, right? Or you can buy a US 10-year treasury yielding 5%. What do you choose?
I'll take the US Treasury. And I think you could have used a lot of examples. It's nothing against South Africa.
It's
part of that's also
specifically South Africa.
I just know the market. I mean, I just have a better understanding of the US's current situation. The thing that I will say is people talk about the US dollar losing its reserve status. I bet that's been talked about for 150 years.
Well, Ryan, it hasn't.
Or sorry,
since it became a reserve after World War I, or II.
Yeah.
Excuse me.
I mean, remember when we went off the gold standard and everyone said the same thing? I mean, not remember when we were there, but remember all the talk about it?
Yeah, reading about that and stuff. Look, I mean, it can change, right? I think you really, the British was the reserve currency or whatever it was, the pound for a while, and before that, I guess there really wasn't one for a long time before there was true globalization happening. But
I think you have to believe, and
yeah,
we're
believe
we're
someone.
talking we're talking
Yeah,
kind of above our pay grade here, but I think you have to believe that American productivity and influence in the world is going to shrink. And
yeah, you have to
if that
believe
is your
there's a
belief, then
yeah.
bet on
You
it,
have
I
to,
guess.
yeah, you have to believe that. Yeah, there's going to be another superpower that takes over, something like that. But yeah, the U.S. reserve status, just because someone bought some oil and didn't go through the US dollar, I mean, that's fine. That's probably a fair it's a fair question for them to ask. If they want to do that, they can, right? It's not, that doesn't mean anything.
Yeah, I think Dalio's been all over this too.
Oh,
I think
Dalio,
he's
he
like,
loves, well, I gotta say, he has some ties to China that he may be getting some funds from over there. So I don't know. He might be slightly biased, but he
I've
loves talking
always,
about the collapse of the economy, and I just don't like that because that's almost again self-fulfilling prophecy. I just hate that stuff, right? Where you have so much influence, and you're like the global economy is going to collapse, and yeah, if you're, yeah, look, I just don't like that talk,
I mean,
right?
he's also, yeah, I don't know. I read his maybe got like halfway through his principles book, which was like one of the most boring reads on earth. But
Yeah,
the other, he is a little hypocritical, and I don't agree with everything he's done. But
yeah,
I
but
don't want to.
he could be totally right, and he obviously has 50 something years of experience, right, as an investor. So
Yeah, yeah, that is true.
yeah. All right,
Um,
let's do another topic because US dollar reserve status is
let's talk
just,
Activision.
yeah, it's just astrology is as one of our commenters said, yeah, let's talk Activision. That's something more concrete. Pretty easy to see what happened here. If anyone that hasn't got caught up with the news, so the United Kingdom, it's called something. The CMA is the acronym, but it's basically the FTC for the United Kingdom. I forget what it actually stands for. They blocked the deal for Microsoft to acquire Activision Blizzard because they believe the deal would hinder competition in the cloud gaming space, which they claimed is going to grow rapidly to around 11 billion British pounds of global annual spending by 2026. Full disclosure here, we do own shares of Activision Blizzard at this time, so we might sound a little biased because we do think the deal should have gone through, but again, don't feel sorry for us or anything. It wasn't these aren't huge swings in losing 50% of value of a position or something like that. And yeah, that's really all that happened. Shares of Activision Blizzard fell 10% on the news, kind of back to where they were a couple months ago. And that's it. Obviously, Microsoft and Activision Blizzard said that the deal should go through, which you would expect them to. They're pretty, I think, harsh, threatening the United Kingdom, essentially saying that if you kind of saw some of those notes.
I
But
didn't
yeah,
see that. What was that?
they're threatening, basically saying they're threatening that the United Kingdom is bad for business. The United Kingdom is a bad place for mergers. It's the worst place in Europe for a technology company to go. They're saying all this, trying to talk their book and stuff like that about how the CMA doesn't understand things. They basically were saying that they honestly sounded like a tech startup person or a Bitcoin person, where they say you just don't get it, bro. Where they essentially said, and I think I honestly agree with them. We can talk about that. They said that the CMA and the FTC do not understand the video game market. But discussion question: what do we think of the decision here? Did the CMA get it right or wrong? Ryan, why don't you go first, and then I'll have my thoughts.
I think they got it wrong. And you threw out one of the big stats, which is the big concern here was over cloud gaming, which really isn't even a market yet. I mean, it's not even a market. And they cited one of their reasons for, yeah, I mean, here's, okay. For everyone listening, Brett showing a chart right now on the gaming market. And there's concerns that Microsoft could be a monopoly if they gobbled up Activision. And one of the big concerns there was because of the cloud gaming market, which we think it will grow. But if you look at this chart, today, the gaming market, I think this is from 2020, is estimated at $165 billion.
And 2022, it's about 200 billion, give or take.
And what would you say what percentage do you think is made up of cloud revenue? 1%, maybe less.
It's much less than 1%, and probably less than 0.5%. If we look at the numbers here, of that 165 billion, we have 85 billion in mobile, 40 billion in PC, 33 billion in console. So I think the key takeaway I have from it, and this is more of someone who is very interested in the gaming market and is trying to become, knowledgeable about the space, and I think we are fairly knowledgeable about this industry, is you want to they wanted to increase competition within cloud gaming, which is not even, no one's really even figured it out. Microsoft has a product and no one else is really trying because the technology isn't there. So they want to increase competition in that, which is a fake market that no one knows what is even going to look like 5 years from now. It's like doing, competition stuff within the metaverse market. But they're going to decrease competition in the mobile market, which is $85 billion, because now you're not going to let the Xbox store really have a chance to compete with a content offering versus Google or Apple. You're going to decrease competition within the PC market and entrench Steam and maybe a little bit of Epic Games as the dominant platforms in PC. And then you're going to entrench PlayStation as the dominant platform in console. And then I guess you have Nintendo, but they don't really compete with anyone. So yeah, that's my takeaways. Is you're gonna, and PC and console are both around $40 billion a year. So just so much money, so much consumer spending, and now you're just going to entrench these other players and not let Xbox try to increase competition in some of these other places for cloud gaming. It just, I saw all the people that cover the markets for newspapers and stuff like that just laughing. They're like, well, what is going on here?
Yeah, I mean, it is laughable. They cited one of the reasons that they don't think the deal should go through is because they don't know what the cloud market dynamics are going to look like, and they think it could be a big market. They said they cited some obscure estimate, which no one has any idea what the size of the cloud market is going to be in 5 years, 2 years, 10 years. You pick it. Like no one has any idea. And they said some random estimate said it might be worth $11 billion, which is trivial in its own right relative to the gaming market overall.
Yeah, it would still be a small part. I mean, it'd be a few percentage points, but it'd be a small part. Yeah. It doesn't really make sense to me. It shows that, in the words of the little Succession reference, the CMA and the FTC are not serious people. They're not, they seem very biased against big tech, which I guess, as an investor, we're looking at that more from just an industry, covering the industry. But from an investor perspective, I think this is the big concern we had, is that these companies do have a vendetta these regulators do have a vendetta against big tech. Now, I want to get to the next question, is what do you think the likely scenarios are from here? Because you mentioned that they're going to appeal the deal. I think that was a little bit of talk from Activision, because they have to say that, right? And I think once it's in July, their deadline for getting the $3 billion termination fee hits, I think they're going to want to walk if they see this is going to take multiple years to close.
Yeah, I suppose. I guess I don't know. I would like to see them appeal the deal. Not if it's going to take multiple years to close. And maybe that was the goal of regulators. Maybe that's what regulators were hoping for, was let's just make this an absolute slog to get through. It's disappointing from, I think, not only an investing perspective, but also, I mean, gamers were frustrated by this too. This would have absolutely helped. I think having Call of Duty under the Microsoft umbrella, under the Xbox umbrella, there could have been a lot of ways for them to make that game more fun, more accessible. If cloud does work out, it could have been, I don't know, that much more seamless to have COD on Xbox, whatever the cloud gaming version is. So I think gamers were upset. I just find it, I don't know.
I bet the third-party publishers were upset too, because PlayStation is a lot more anti-competitive to the third-party publishers, where they really go for these exclusive titles that the regulators are worried about. Anyways, there's some interesting data out there that third-party titles do not do as well on PlayStation versus Xbox, and PlayStation does have a growing part of that market. There's a good comment here from Rod saying the cloud gaming platform from Google was shut down about 3 months ago. Not a great indicator for the cloud market. Yeah, it's not even a working technology yet. Google Stadia didn't work at all, and there's a reason for that. It's just not ready. So it's almost like blocking a acquisition for social media in 2002.
Yeah. And I guess my other thought here is what would, and I know this probably won't happen, but what if Microsoft said, or Activision said, all right, we'll go ahead without the UK market?
Yeah, I think maybe they would do that if Microsoft didn't have all these other business lines, because UK is probably not that big of a, and maybe it's like 5% of their revenue. I know it's an important market for them, especially for the console market, but they would have to Microsoft would have to forego Azure, Office 365, and all that stuff. So I don't think the juice is worth the squeeze in that regard,
You
but it would
think
be an interesting tactic.
that would
Maybe
make
they
them,
could threaten it. Maybe they could threaten that and say, look, we're going to cancel Microsoft Office and ruin your economy
you don't think,
by taking away Excel. But
you don't think they could say like, hey, I mean, that then it would maybe
that would
prove
make them
that
look pretty bad.
maybe that would prove that regulators are needed to step in. But
Yeah.
the couldn't they say like, okay, we're not going to serve Xbox customers there? Because what is it, 4% probably, maybe less of like Activision's revenue. So obviously they would be paying a little bit more. I don't know how much they don't say in their filings what the UK accounts for, but I'm pretty sure the PlayStation is the leader over there.
By a long shot. Yeah.
So I don't know. Is that on the table? Probably not, but I kind of wish it was, because then all the gamers in the UK would be like, yo, just pass it, like let it go. We want COD.
Yeah, and again, the other publishers, which is what they're trying to say that they're helping out here. Like the other publishers don't want Steam to get more powerful. They don't want PlayStation to get more powerful, and they do not want Google and Apple to get more powerful. Which in reality, there just needs to be another app store that hops into play for the mobile department, so they don't take that fat take rate without building a dedicated system. Because again, the take rate, like Steam takes a big take rate, or PlayStation takes a big take rate, but that's because they have the dedicated hardware for gaming. And it's more of a collaborative process. But again, I'm going down a different tangent. You have something else to add?
And I bet like if they, and I'm not even sure this is how like logistically it could work, but if they said like, okay, we're going to take Xbox services out of the UK, I bet EA would say like, no, please, no, like let us, like they'd be lobbying for the deal to go through and for Xbox to stay in the UK, because EA has, I think, a huge, maybe not as big as the US market, but a big chunk of their FIFA revenue, especially, which is their
and racing
leading revenue.
Racing's huge in the UK, and they're the biggest racing game company.
Yeah, I mean, I'm sure they would be incredibly frustrated by it too. So I don't know, I think I side with Microsoft putting pressure, or Activision putting pressure on the UK. I think it's kind of, and when you look through the report of like why they chose not to do it, it is kind of laughable, because it's very clear they don't understand the market, and cloud as a percentage of gaming overall is less than 1%. How can that be a monopoly? Like, how could that be your concern? That maybe one day it is worth 2% of the overall gaming market.
Yeah, it doesn't make much sense. I did see, and they had all the people from Microsoft and Activision doing a blitz for the media. So I believe it was on CNBC. It was Bobby Kotick, the CEO of Activision Blizzard, and I didn't catch this part, but I saw someone tweet a quote. So this isn't a direct quote, but they're basically saying that yesterday or this week, the CMA met with the FTC. So I think the FTC convinced them to stick with on their side and block the deal. But it's just disappointing, because I think this means a less healthy gaming market going forward. And I want, just as an investor and following this industry, it's so fascinating. I want a healthier gaming market where the platforms don't, there's more competition among the platform level, and the platform, I mean, either the console platforms, the PC platforms, or the mobile platforms, or I guess the cloud platforms, where without this deal, I think there's less competition, because there are inherent competitive advantages in winner take all scenarios here. And yeah, look.
And I think acquisitions have benefited gamers over the last 20 years. EA produces such better games because it's that much bigger and is able to have the resources to invest in it. It's not like there's any monopoly here that's just gouging consumers. Consoles have been similar prices for decades. Game prices haven't changed for decades.
They're actually down a lot if you, in real terms. I think
Yeah.
I saw someone do the math that they should be around $110 per game now, and most of them are actually going. A lot of them are going towards free. Yeah, I mean, yeah, I think Halo fans might be upset recently because of the Microsoft acquired them, but in general, yes, the acquisitions haven't really hurt the market because the industry is interesting where there's so many studios starting up, and it's all about whether you come up with a good game or a lasting franchise, and you can't just acquire your way to success. You're acquiring skilled people, you're acquiring maybe some brands, but it does not guarantee at all that you'll have success because, I mean, for one, Xbox really hasn't succeeded with their first party strategy outside of Minecraft.
No, and for the people that, and I'm pretty sure they acquired Minecraft initially.
That's what I'm saying. For first
Yeah.
party, like, yeah, they acquired them, but like it's a first party game for them now.
And for the people that are like, oh, no, I want as many indie studios as possible, it's so difficult to survive as an individual studio in the gaming world because you're going to have, even if you have a hit, you're going to have flops. And those flops, if you're in a big company, aren't the end of the world because you have the resources to weather it and then produce a new game. But if you're an individual studio and you have those flops, it could be the end of the franchise, end of the enterprise. So
yeah, and the last thing to close on that is that the data that I was trying to reference earlier, but I can't really remember the exact stuff, is that the indie studios with Sony on PlayStation do not do nearly as well, and they kind of target their own exclusive titles. So you want more competition among the platforms for these third-party titles, for these indie games, because if it's all Sony or if it's all Steam, yeah, Steam doesn't really produce their own games, so I guess it would be fine. But within Sony, specifically on the console market, you don't want that. How am I trying to say it? You want more platforms out there, or as many as possible that are succeeding, because right now Xbox, yeah, can offer it, but it's not nearly as big of a portion as for revenue for these third-party titles as Sony or Steam or the mobile platforms. And yeah, it doesn't make sense in general. But
the
you want to
other,
go to the next tech topic, or you have something to final here?
nah, I guess we can leave it. I mean, the UK, congrats, you've now blocked the Activision deal and you blocked Facebook from buying Giphy. Thanks for saving the tech
That's
world.
why I think that RIP Logan Rice, the when he said I love you but you're not serious people, that's got to be so good.
All right, Spotify had earnings. Thoughts?
Yeah, pretty much as expected on earnings side, because I said it would be bad, and it was really good on the user side, but
Yeah.
it's rest of the world, so you got to almost, from a monetization perspective, just because these markets have lower GDP per capita, you got to maybe divide them by 2 for a lot of those. So I don't know if it's that impressive, but it's not a bad thing that they're getting usage in a lot of these places. And yeah, it was really as expected. I did like how they talked about reducing dumb podcast exclusive contracts, which I think means the old celebrity contracts that they signed that didn't really amount to much, where that old the prior head of content, I forget her name, got fired for that, it seemed like. So that seems better because the exclusive strategy seems smart. And then it's just really the rest of the year watching for gross margin expansion on because they said this is the year it's finally going to happen, and we'll see. So yeah, I think ad supported was a little disappointing, but they said it was going to be light, and yeah, you just need that to accelerate because they have the fixed cost for the advertising spend for a lot of that, and they need to grow that. So anything you saw that was insightful, but I thought it was really as everyone kind of as I thought it would be, right? No big surprises here.
Yeah, and it kind of surprises me that stock still trades on user growth. Like they beat users and stock jumped like 9%.
Well, subs was pretty impressive.
I know, but like that's just never been over the last 2 years. I would say that has not been a sticking point for me as an investor. Like I'm not concerned that it's a good product and it's going to attract more subs over time. I'm concerned that, what are the economics going to look like? What are the margins going to look like for this business? And yet the stock really kind of still trades on those user numbers. which I mean, whatever, half a billion subscribers or users. I think that's obviously very impressive, but um, it's the gross margins are still an issue. And I did find it a little interesting that they were kind of vague with why their gross margins, they were like other cost of revenue increased. And someone asked on the call, like, why? And they're like, well, you know, cloud computing costs or something like that. I was just like, well, that's
Yeah.
semi-concerning, but
Yeah, I think it's just with the user growth in a lot of these rest of the world markets, which for them is everywhere that's not Latin America, North America, or Europe. If it's growing quicker, that cost is going to grow and they're not going to make as much money off of that. So,
yeah, it makes sense. I hated some of the questions in that Slido. They always
I
have.
put in like 5 questions that all basically said, how are you assuring that you're not hiring too many people again? But they didn't like it. They didn't want to ask.
They're not taking those. I think
Yeah.
I'll bet they have people.
Oh yeah.
I
100.
bet
Well, they have
Spotify
someone
has
read
people on
it.
the
Yeah.
call like they're like, okay, let's get 10 people to like that question,
Well,
or
they can ask whatever they
let's
want.
avoid. Yeah, they're avoiding some of the tougher ones. I thought that it was kind of a mixed bag.
Hey, at least they didn't. At least they didn't just say AI over and over and over again. They did
Yeah,
talk about
what do
it,
you
but
think of the
they
Google?
always, yeah, almost the same thing where it's just expenses. Everything looked fine to me. The YouTube isn't really a concern because they highlighted that they're growing premium. So if advertising revenue is kind of stagnating for the time being, it's not that big of a deal if their premium subscribers are growing so much because that's where the revenue is going. But cloud is great and search is fine. Yeah, seems. And then they just as
And
it
cloud
seems like
was.
well,
It's funny. They're like, yep, we just moved some numbers around and we're profitable now. It's like,
no, for the servers, the
yeah,
server stuff.
the server depreciation. Like, all
Yeah,
right, well,
to be fair, all the companies have been doing this, so I think they're showing that it's like
no, the
within
tech's
this,
improving for sure, but
I guess, or it's
I
lasting
find it
longer than they thought. Yeah,
funny that that's all it took was a little useful life extension, and boom, where Gap is or Cloud is profitable by a significant margin. I guess that goes to show how much of the expenses related to cloud infrastructure are um, the hardware, the chips, stuff like that.
the upfront costs. A lot of upfront costs, less maintenance costs, and yeah, it's a lot of look at Amazon's capital expenditures chart, and yeah, you can see that. But that is, they had to throw up a lot of capital up front, so free cash flow is going to be, the faster the cloud grows. I think we saw this with Amazon. The worse cash flow looks in the near term, but depending on how strong you think the moats are, it can help over the long term with durable cash flow generation.
I know part of me was like, I looked at Spotify's and they're like, yeah, our cloud costs jumped more than we were expecting or something like that. And I was like, well, that sucks, but I'm a Google shareholder and maybe GCP revenue will be better. So
yeah, well, and it was. And
yeah,
that is one of their biggest customers, but obviously not just them moving the needle. But back to the honestly with Spotify, if their cloud costs are going up, that means that their usage is going up from their consumers, like hours spent on the platform. And they did highlight that hours spent per user is going up, which in the long, like that's fantastic news. I thought all their user KPIs were great. They said DAU to MAU was better, users were better, podcast mix was better. I mean, in the long run, it's not even users that is the most important. It's consumption on the platform, especially if they're going to be advertising driven, which TBD if they can actually execute on that. But yeah,
okay,
but on Google, I don't know.
Yeah, I thought it was a mixed bag. Okay, we have like 15 minutes. There's been a ton of earnings, so I'm thinking we do. I don't know which of them you've looked at, but just a quick fire thoughts. Let's start with Meta.
A little underwhelmed versus the stock price reaction. So I think if I was deciding how much the stock should be up, I would have maybe said a couple percentage points. I think the Reality Labs spend, people just forgot about it, but it's no different than they said it would be. But Zuckerberg and their executive team seems to be the only one serious about fixing the overhiring problem in a real way instead of just talking about it. So,
Dropbox.
well, big tech.
They're medium tech.
They are medium tech. If they do the buyback enough, they will be small cap tech. And apparently the stock price stays at $20 forever. I think the usage stuff with Meta seems fine. It's not blowing it out of the water, because if you look at a lot of these emerging markets, Instagram and WhatsApp are dominating, but I think it's masking. Well, I don't know. Facebook seems to be doing fine, but I don't think the usage on there is probably stagnating in a few markets. But again, that has never actually materialized and hurt the business. It seems like fine, but I just wonder, can they really jump ARPUs that much across all their apps? I'm just not sure. But again, I think their stock is doing the best because of the right sizing the cost structure, to use the consultant term. They're actually doing that with how many people did they lay off? Like 20 something thousand versus
more, I think.
20, maybe a little over 20K versus what, like an 80K employee count. So very, very sizable versus their prior one.
Yeah, it's true. Yeah, I thought the same thing. I thought the quarter was okay, but maybe it's just the expectations were so low coming into this year. It's like the size of the social media businesses continues to blow my mind. The fact that they're still growing at 3 billion daily active people. But I imagine a lot of that's still from WhatsApp, and I don't know. I think there might be, they're saying that like maybe Reels monetization could be on par with feed and search feed and the other properties. But I wonder if it's like structurally different. I wonder if it's, and they said it's like a very different feed concept, or it's a very different like advertising concept. When I think about like TikTok or Snapchat, which is maybe what it feels more like, it feels like it would just be a lower. If I'm advertising there, I'd probably pay less for it.
Yeah,
I guess it depends on the targeting capabilities, but
yeah, I don't know how much that matters, but I think you could be right. I just don't. Yeah, how strong is the growth going to be? I just.
Also,
part of me thinks it's great, but yeah, and also Reality Labs looks worse and worse. The revenue is nothing. It's actually getting worse, I think. And then their other category, which again
down
doesn't
50%.
really matter. Yeah, and their
Reality Labs revenue was down 50% year over year. I'm pretty sure.
Yeah.
And now that stuff's probably lumpy because it has to do with like hardware launches, but okay, like I'd say 6 months ago we said that Reality Labs is going to be a flop and that this is not something that consumers are asking for. Like there's been no sign that this is going the right direction, at least not from what I've seen.
Yeah, and we sound like super bearish on Meta. I'm really not, but I just don't know how, like the risk reward versus owning them versus Google or Amazon. And I guess really we own Google or Amazon compared to them at these prices. I think it just makes a bunch more sense. Especially here's what's interesting: a lot of the costs for the capex have been AI, right, or AI related investments. That's going to flow through the income statement, and if that's not a one-time thing and that's a permanent upspend, they're going to have to, it's going to hurt their margins over the long term unless the monetization is that much better. And they don't have a cloud infrastructure division to outsource to sell those costs and capabilities to other people, which is why I just like, and we'll talk about
they have all the negatives of cloud. They have all the costs of cloud and none of the revenue.
Yeah, exactly. Or they don't get to have the benefits. We are going to talk about cloud next week because as we're recording this, it's 1 hour before the Amazon earnings. So want to get that context. But I do think in general, I don't know why. Look, Meta could totally work from here. It could double again over the next 5 years. I would not be surprised, but I don't know why people like them more than any of the cloud companies, because I just think that is just so much more rock solid, especially with this AI boom. But
I mean,
Meta's it's an enigma for me. It's an enigma for me. I can't get a grasp on it.
No, I'm still impressed by the family of apps. The social media properties and their durability has uh impressed me a lot. And there was a point when I was saying that Instagram was going to go the way of Facebook and kind of lose its relevance with younger people. That just hasn't happened. It's still,
It
so
plateaued and now
popular.
it's gotten a little bit of its mojo back. I'm reading it right. I don't use it, but that's kind of what I read into it. Is that true, you think?
Yeah, I believe Reels. There was a point when TikTok was stealing a lot of share, but Reels just basically replicated it and stole that share back. It seems like based on TikTok's engagement data. So, yeah, I'm really impressed by the social media businesses, but it's like everyone just forgot that Reality Labs is a huge cash suck. Anyway, all right. Other ones. Did you read Roku's report?
Glanced at it. Yeah, they gotta manage those operating expenses because again, usage looks great. Market share looks great. I don't know what happens with them with their how they should be able to earn a good ad spread, whether it's their first party stuff with their own channel or the take rate on other stuff. I just don't. Why is it not showing up in the earnings? Why are their expenses too high? Are they investing in a lot of dumb stuff or what's going on? Like what if you kind of
I think they might be. I think some of the Roku channel. You're saying the Weird Al Yankovic movie didn't blow your
yeah,
mind?
the content's been buying up the Quibi stuff that was just totally useless. And well, or they working on smart speakers and smart lights. Yeah, that R&D might be a little bit of a waste.
They're also
It's
manufacturing their own TVs now.
yeah, that could be cost savings though, or the long run.
Essentially, yeah, it's kind of hard to say.
But I just don't get it. These should have the advertising and platform stuff where they earn a little bit of fee on whatever, through the distribution, like any other platform. They
The
should have
layoffs.
very high margins, very high
Yeah,
margins.
yeah, I agree. It's like there's the business model. If you just described it to me without giving me any of the numbers, I would think like, wow, that's got to be really profitable. But it's just not showing up. And I wonder if some of that has to do with the negotiating leverage or the contracts between the big streaming providers, Netflix, YouTube, what else? Disney, but I think they get a lot of revenue from Disney. Maybe they just aren't very favorable contracts with them. The other part, yeah, I don't think their layoffs trickled through the income statement this quarter yet, so they haven't seen that. So maybe losses look worse than expected. But yeah, this should be a way more profitable business than it is. Like plain and simple.
Yeah, let me throw up the stratosphere chart. Let's see if I can. I want to look at it and see what their operating income has looked like because it just hasn't improved, and they over earned during 2021 or grew quicker, and there was a bit of the advertising bubble, but they haven't shown any ability to fix that. Let's go quarterly.
What about MasterCard? Did you look at their earnings?
Not yet. I looked at Visa, but
Pretty dang good business.
yeah, I want to talk about, after I share this little chart let me describe it. So if we look at Roku pre-COVID, they were losing a little bit of money each year as they're trying to scale the business, I guess, not a big issue. During COVID, for the first few quarters, they started printing some solid operating profits, $65 million in March, December 2020, 76 million in March 2021. But as kind of the COVID bubble popped in 2022, we've seen increasing operating losses. And it looks like at the end of 2022, we saw a $250 million operating income loss. Maybe some of that was one-time charges, kind of looking at this chart, and they haven't shown the ability to quickly right-size their cost structure. I said that again. And the same thing happened in Q1. So how are they going to fix these earnings? But yeah, we'll see. But here's some on the card networks. I want to show you this. And again, I'll describe it to people. But I thought it was super interesting. We did talk about on prior shows about the excess savings chart, right? Stuff like that. And how you're wondering about how much was really left on consumer balance sheets. So it looks like someone actually ran the math. And I'll share it with you here. Let me click on that. Oh. Okay. Can you see that?
Yeah,
Oh,
I
God.
can.
They're trying to recommend me that viral Tucker Carlson tweet. Can't escape it. Everyone ignore that if you're watching. But here's the chart. I'll describe it. Pretty easy to see. So starting in COVID, because of the dynamics of the pandemic, and everyone all knows that at that point, there was huge cumulative excess savings in just from consumers, and it went from basically $0 to $2 trillion. And then, the stimmies help with that. It flatlined. And now in 2022, they've been drawing that down. And now we're at about 1 billion left of cumulative excess savings. And according to this chart from Bank of America, say they drew down about $1 trillion of excess savings in 2022, and that equates to a 6% boost in expenditures. But here's the interesting note, and I'm going to go to the next slide. All right, Twitter can't load anymore. This one is a bit complicated, but I'll just describe it. What he said here is the above graph shows that the bottom 80% of households have already burned off the excess savings they accumulated in 2021. This is why credit card debt has expanded rapidly. See below, credit card debt is growing. So my thought here is that, and maybe you agree, I'm a bit nervous about the growth rates of the payment networks and the credit card companies right now, specifically American Express. I want to see this excess savings get spent off and see whether that was how big of a catalyst that was to growth. And I wonder
Specifically Amex, huh?
Well, Amex, Visa, I said the card networks, Visa, MasterCard, Amex. I guess those are really the only ones. And then
I know, but I mean, looking at that chart, I would think that the people with more that still have the capability to spend are the Amex customers.
Yeah, for how long though?
I mean, they're the wealthiest, it looks
Yeah,
like.
but the $1 trillion in savings that's left is them. That's moving downwards. And eventually that gets spent off, right? And how much of that was a one-time boost and how much of that can be normalized because incomes aren't growing to compensate with this.
Yeah,
I just worry about that. Things might be fine, but I just worry about that with these card networks that print this growth and people go, I'd buy this at 30 times earnings because it grows 10% a year forever. Maybe not.
Yeah, it might just be tied to, at this point, I think MasterCard and Visa are basically just consumer spending plus 5%.
Maybe. Yeah. Somewhere around those lines. I know you said 5%. You didn't mean exactly 5%, but like a little bit higher.
Plus a little something. Yeah.
Yeah.
They're also doing things to, I mean, at this point, yes, the bulk of the business is basically like global spending, but they're also doing stuff to like structurally grow. They're still adding merchant locations. I think they just crossed 100 million. The total cards in force is still up significantly. It's at 3.2 billion. I think it was at like 2.6 a year ago. So, and they're still growing aside from just overall spending on their cards.
Yeah, I just wonder how fast though. I have no doubt these companies are going to grow over time and they are inflation resilient, but are they growing faster than normal than they would be, right now, just as this excess savings? I mean, it's going to get spent off over the next few quarters, so we'll know the question for sure, I guess, a year from now. But yeah.
Okay, we got 2 minutes. Last question. Were there any earnings that stood out to you this quarter?
Yeah, I've just been looking at outside of our own portfolio. I just look at the big ones, and I guess Chipotle was pretty strong margins. Maybe hindsight, people should have been able to see that because of food inflation coming down and them still raising their prices consistently. But yeah, I mean, they keep knocking it out of the park. I worry about, we've talked about it, worrying about what would you call it? Food quality going down. But maybe that shouldn't have been a bull case because Americans seem to like bad food. So
you just have a more advanced palate.
No, what do the Europeans always talk to us about when we talk to them about Hershey's and stuff like that? We seem to have
disgusting,
yeah. So maybe the food quality going down was a good thing, and not being as fresh anymore was a good thing for growth. But besides that, that's not really impactful anymore. I mean, they impressed me with their margins. I wonder if they can sustain 15% plus. What do you think?
Yeah, I think they can. I mean, I still go on a regular basis, and I don't really check the price that much. As long as it's around like 10 to 12 bucks, I'm happy.
Yeah, nothing. Yeah, nothing where you're like, whoa, this is a huge. Yeah, nothing. If it's still almost,
I mean, it's
nowhere
still,
close, nowhere close to an expensive dinner or something like that.
yeah, that's what I'm saying. It's still a good alternative relative to like sitting down somewhere, and you get the same amount of food and it's higher quality than fast food. So
Yeah, and no one
still,
seems to want to. Yeah, no.
no one's replicating it either, I guess. I mean, not,
Well, Qdoba's owned by, I think, some Jack in the Box, and they totally botched it. But yeah,
yeah, there just isn't that many healthy, like convenient locations.
for food. Yeah,
Yeah.
I would. Yeah, and the percentage of, like, for me
Sweetgreen,
personally, yeah.
watch out.
Sweetgreen. Watch out with those negative, with that income statement. I mean, my God. But yeah, and the percentage of food expenditures that are going to restaurants continues to rise. I would argue that maybe that is a bit of a bull market phenomenon because it's so much more expensive, but the long-term trend of that is undeniable. All
All
right.
right, it's time.
That's going to do it. Thank you all for tuning in. Thank you for the few who joined us on the questions here. Really appreciate it. These go live every Thursday. You can watch the replays on YouTube or Spotify, or listen when they come out on your favorite podcast player of choice. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. We are general partners at Arch Capital, and clients may hold positions, discussed in this podcast. Thank you, everyone, again for tuning in, and we will see you next week.